Okay, let's unpack this. We're doing a deep dive into a really major structural shift in the global pharma landscape. It's the full consolidation of Biocon Biologics. That's BBL under its parent company, Biocon Limited.
Right, and this is a move that's set for completion in early 2026. It's high-stakes corporate finance, really, clearing the way for some very high-value biopharma assets.
And it feels like the kind of move that just dramatically simplifies the whole group structure.
It does. It signals that Biocon wants to be taken seriously as a top-tier global player in biosimilars. They're fundamentally resetting their entire foundation.
Absolutely. So we're tracking Biocon Limited's decision to acquire all the outstanding minority stakes in BBL. That's about, 23.3%?
Yeah, held by some major institutional investors. You've got Viatris, Serum Institute Life Sciences, and a few others.
And when this is all said and done, BBL becomes a wholly owned subsidiary. It just removes all those layers of complexity and dilution.
And the real centerpiece of this whole thing is the exit of Viatris. They were the largest minority shareholder. Viatris is selling its entire equity stake in BBL for a total of $815 million. It's a massive exchange.
And that $815 million figure is key. The way it's structured tells you, I think, everything about Biocon's confidence.
Oh, for sure.
The payment is split. $400 million in cold hard cash,
right,
and the other $415 million in newly issued shares of the parent company, Biocon Limited.
So our mission today is really to explore the dual significance here. First, why Biocon believes this streamlined, fully controlled entity is essential for them. And second, why the market dynamics around their flagship product justify this whole strategic overhaul.
Okay, let's start with the mechanics. This move, it instantly simplifies the corporate structure. Before this, you had all these minority partners.
Which means every major decision, every financial metric was just subject to so much complexity.
Exactly.
If you connect this to the bigger picture, it moves BBL's massive and high-growth revenue stream. We're talking 62% of the group total, from being partially earned to being 100% visible on the listed company's balance sheet. That's pure alignment. And that really appeals to institutional investors who, they crave that kind of simplicity.
And they've locked in the valuation for the equity part, right? The share swap was fixed at a regulatory floor price of around 405 rupees per share.
That's right, based on December 1st, 2025 data. Now let's talk about Viatris's exit, because this is where it gets really fascinating. This was not a passive cash out.
Hey.
The agreement actually includes an acceleration of their biosimilars non-compete restrictions.
Meaning they get their freedom back faster than expected.
Exactly. For all markets outside the U.S., those restrictions expire immediately once the deal closes.
Immediately.
And for the really critical high-value U.S. market, that non-compete expires in November 2026.
That's significant additional optionality, I think was the CEO's phrase. He said monetizing the stake and regaining that global market access gives them a huge opportunity for future growth.
It does. They essentially converted a passive minority stake into $400 million in cash and a clear path to re-enter a market they know really well. You could say they paid to buy back their ability to compete. It's a fascinating pivot.
And the timeline is aggressive. Shareholder vote ended December 2025, completion by the first quarter of fiscal 26.
They're moving very fast.
Which brings us to Biocon's side of it.
Yeah.
Why do this? Why issue shares and pay cash to regain control? This can't just be paper shuffling.
No, it's a focused strategy to unlock deeper value. The consolidation really unlocks three key things. First, you have the financial metrics. The combined company instantly gets a larger scale, a bigger, more transparent balance sheet. That attracts larger pools of capital.
It makes their underlying value just easier to see.
Precisely. Second, operational synergies. They can now use infrastructure more efficiently, consolidate resources like shared services, and just reduce duplication and costs.
And the third,
optimize capital allocation. They get a single, unified strategy. So management can now move quickly to invest capital into the highest return opportunities, especially their high-margin products.
I get the synergies, but let me, play devil's advocate for a second. Issuing $415 million worth of new shares to Viatris, that could be seen as dilutive to the existing shareholders, couldn't it?
That is a critical question. And yes, dilution is a short-term reality, but the strategic payoff is stability. By including shares, Biocon is basically aligning Viatris's future success with its own. It keeps Viatris invested.
So it's a trade-off.
It is. And by balancing cash and equity, Biocon also conserves crucial cash that it needs for its ongoing high capex and, the very expensive commercial launches for products like Hulio.
That makes sense. And speaking of their finances, they've been on a bit of a debt reduction warpath leading up to this.
Oh, absolutely. It was a systematic cleanup. It significantly reduced their risk profile. If you look at the net debt to EBITDA ratio, which is a key measure of solvency.
Right. How long it would take them to pay off debt with profits?
Exactly. That ratio was aggressively reduced by about 2 times.
2 times. That's massive. Where did it start and where is it now?
It dropped from a high of 4.3x in fiscal 23 down to a much, much healthier 2.5x in the first half of fiscal 26. Reducing that ratio just means you're moving from high leverage and high risk to a position of real financial flexibility.
So how'd they pull that off?
A couple of smart moves. First, a qualified institutional placement, a QIP. They sold shares to large investors and raised about 4,500 crores.
And that money went straight to paying down debt.
Specifically to redeem structured instruments, which were expensive, high-interest debt. That move alone is projected to save them about 300 crores, or roughly $34 million in interest costs every single year.
Wow.
Second, they tackled their debt maturity wall. They refinanced existing debt with a new offshore-listed bond for $1.2 billion.
Which sounds technical, but what does that do for them long term?
It extends their debt maturity profile by 5 years. That pushes major debt payments down the road and gives them more liquidity and flexibility now. A high capex company like Biocon needs that breathing room to invest back into the business, not just scramble to pay off lenders.
So the financial plumbing is now robust.
It is, and it's all designed to support the core asset. All this financial restructuring is aimed at maximizing the value of the biosimilar segment, which brings us to their key product, adalimumab FKJP, or Hulio. Hulio is critically important because it's not just a biosimilar to AbbVie's Humira. It holds the prize designation of being an interchangeable biosimilar. The FDA granted that status in 2025.
We hear biosimilar a lot, but
Right.
What does interchangeable really mean, commercially in the U.S. market?
It's the game changer. Think of it like Tylenol versus generic acetaminophen at the pharmacy. For a standard biosimilar, the doctor has to specifically write that prescription.
Okay.
With the interchangeable designation, pharmacists in most starts can just substitute Hulio for Humira without needing a new prescription from the doctor.
That just streamlines everything. It must reduce friction in the system dramatically.
It does. And that status relies entirely on rock-solid science. They ran a pivotal clinical study specifically to prove that repeated switching between Hulio and Humira was safe and effective.
And what did those studies show the FDA?
The main focus was on pharmacokinetic similarity, or PK. That's how the drug is absorbed and cleared from the body. The study confirmed strong PK similarity. The key parameters were well within the FDA's accepted bioequivalence range of 80 to 125%.
So the body handled Hulio exactly the same way it handled the original drug, even with patients switching back and forth.
Precisely. And in terms of efficacy, the outcomes were highly consistent. For example, the PSI response levels, which measure skin clearing in psoriasis patients, were comparable between the groups.
And what about safety? That's paramount when you're switching patients off a complex biologic.
That was the final hurdle. The study showed adverse events were reported at similar rates. Crucially, serious adverse events were rare and occurred at nearly identical rates, 1.6% in the non-switch group and 1.7% in the switch group.
That near-identical safety profile is the foundation for that interchangeable label.
It is.
But it is important to remember these are powerful immunosuppressants.
Absolutely. Adalimumab products, including Hulio, are TNF blockers. That means they suppress the immune system. They carry a boxed warning because they increase the risk of serious infections like reactivating latent tuberculosis.
A vital reminder of the risk that comes with the reward in these cutting-edge therapies. So, zooming back out to the business finances sorted, flagship product validated, what does this mean for the scale of the new consolidated Biocon?
Scale is arguably the biggest immediate outcome. Biocon instantly positions itself as a top 5 global biosimilar player. They've got commercial reach in over 120 countries, including a self-led presence in North America and Europe.
And it seems like they've already done the heavy lifting on infrastructure investment.
They have. Their major capex is largely complete. They've got validation ongoing at their Bayview antibody facility, and their Cranbury facility is expected to launch commercially from fiscal 26. I mean, they are positioned to meet demand for the next 5+ years.
Beyond biosimilars, which is 62% of revenue, we also have to talk about their other engine, the CRDMO division. Contract research, development, and manufacturing. That's 21% of their revenue.
And that CRDMO division is a very robust pillar. It's benefiting from some major global tailwinds. It provides integrated services, helping big pharma companies outsource their R&D and manufacturing.
And that market is huge, right? We're talking about an 8 to 9% compound annual growth rate forecast through 2029. Why are pharma companies accelerating this outsourcing?
Two main drivers. First is just cost and complexity. Manufacturing biologics is incredibly difficult and expensive. Second, there's a big geopolitical dynamic at play, often called the China plus one sentiment.
Unpack that China plus one concept for us.
The reality is that pharma companies, especially in the West, are aggressively diversifying their supply chains away from a reliance on any single region, and that includes China.
Great.
They're actively seeking reliable, high-quality partners in places like India to reduce risk. And Biocon's integrated CRDMO services, backed by over 5,600 scientists, is perfectly placed to capture that shifting demand.
So the new consolidated structure creates a much clearer, stronger investment thesis. High growth areas like immunology and oncology, all underpinned by a de-risked debt profile.
That is the summary. Biocon is simplifying its structure at the exact moment its underlying assets, especially Hulio, are proving themselves scientifically and commercially, and the financial plumbing is ready to support the next aggressive phase of growth.
Which leaves us with Viatris, now cash-rich and free of its non-compete. It begs the question, what happens next for them?
It really does. The deal was structured to let them re-engage in the biosimilars market ex-US almost immediately. Are they going to rebuild, acquire, or partner? The market is going to be watching them very intently. That $400 million in cash is burning a hole in their pocket.
And this brings us to our mandatory, this is not financial advice segment.
Right. We've established that Viatris now has the capital and the freedom for a major change. The sheer uncertainty around how they deploy that cash, it just creates a perfect storm for volatility.
So given the capital and the volatility from the expiring non-compete, our outrageous but plausible trade idea is this: a long straddle on Viatris, ticker VTRS, with options maturing about 18 months from now.
The core bet is just on massive volatility. If Viatris executes its strategy, say, they announce a major new partnership or a successful acquisition that capitalizes on that immediate ex-US freedom, the stock could surge.
On the other hand, if they struggle to translate that $400 million in cash into meaningful new business by the time the U.S. market opens up for them in November 2026,
then the stock tanks. Market skepticism, disappointing guidance, you name it. A long straddle is a bet on a big move, not the direction. This company is either about to hit a home run or face a massive disappointment.
Either way, that kind of swing is what the trade is built on. And remember, this is purely an analysis of market dynamics, not a recommendation for your portfolio.